Hello, everybody, and welcome back. Today, my guest is Ivailo Dikov. Ivailo is the leader of the Japan equity team at Eastspring Investments. And today we want to discuss about recent developments in Asian capital markets and especially for Japanese equity. Welcome, Ivailo.
Hi, Thomas. Good to be here.
Ivailo, China's sudden turnaround in COVID policy changes everything. So what does this sharp change mean for Japanese companies, and what risks does it entail, and who will benefit in the short and medium term?
In terms of China, we've seen a rapid reversal in their COVID policies. And in terms of risk in the short term, really, it's mostly related to supply chain disruptions. And this is mostly related to if contagion spreads widely within the country, and it could impact utilization of factories, it could impact mobility, it could impact consumption. However, talking to companies and getting some initial anecdotal evidence about what's happening on the ground, it seems that some of these risks did materialize in December, where some factories saw lower utilization rates. However, going into January, a lot of the things are calming down and getting normalized. So yes, there are risks in the short term in terms of disruptions, but beyond that, I think the opening of the Chinese economy is very positive for Japanese companies in general. And this positivity comes mainly from three main channels, in my opinion. One of the channels is the recovery of the demand in the domestic Chinese economy, which is very positive for Japanese companies with exposures to the domestic Chinese market. This would be companies in the automobile supply chain, some big Japanese retailers with big presence in China, companies with exposure to construction machinery and the supply chain there, and also exposure to real estate. So opening of the Chinese economy and supportive action by the Chinese government for growth in China is a positive for these companies with exposures in China. A second channel, which is positive for the Japanese companies and Japanese economies, through the channel of inbound tourism. This might take a little bit more time as Chinese tourists start traveling abroad, but historically, pre-COVID, the consumption of Chinese tourists as percentage of tourist consumption in Japan was above 30%. They're quite a significant portion of the consumption of tourists in Japan, and reopening of this tourism or inbound tourism into Japan is going to be very positive for some companies in the retail businesses, in logistics, and also transportation, both railway transportation and air transport. Another channel of positive impact on Japanese companies could be through the tightening demand supply in some material space as the Chinese economy improves, like, for example, steel. So you have these three channels through which Chinese reopening could be very positive for Japanese corporates. However, this is only the beginning. Remember, it's very important. We are very disciplined in terms of valuation as investors. Some of these dynamics that I just described have already been priced in some of the Japanese stocks. We focus on, in our investment approach, we focus on through cycle sustainable earnings, which drive the valuations of the companies we invest in. And if we have a big buffer of safety, we invest in such companies. In terms of companies which are related to some of this Chinese reopening dynamic, we have investments in domestic railway transportation companies and also domestic retail companies, and also in the automobile supply chain, where we still see very compelling valuations.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
The Bank of Japan is sticking to its negative interest rates. So while the rest of the world is turning the interest rates screw, so how long can this go on in an inflationary environment like we currently see it?
This is a very relevant question. In fact, the Bank of Japan did surprise markets in late December last year by widening the band. It's allowing the 10-year yield to fluctuate within, and this was a quite surprising timing for the Bank of Japan to do this adjustment to its monetary policy and a yield curve control policy. The Bank of Japan tried to address this as a measure to address the functioning of the Japanese bond market. But we think it's also a realization that inflation expectations have gone up to levels of pre-introduction of negative interest rate policy in Japan, so they've increased. And also we've seeing a more broader inflation and stickier inflation in Japan. So we think this move from the Bank of Japan is increasing the probability of further adjustments to its monetary policy going forward. In terms of our portfolio, the move has been very positive for our holdings in financial companies and Japanese banks and life insurance companies in particular. The market had been for a long time extrapolating negative or very low interest rates in perpetuity in the valuations of these stocks. And the market was disregarding the management of these companies, the effort of the management of these companies to improve the fundamentals of the company in terms of cost and capital. And what's happening at the moment, the inflation dynamic and the Bank of Japan policy adjustment dynamic is challenging these views. And we've seen some positive contribution from our exposure in this space.
Japan is reopening. So what stimulus can this provide for Japan's economy, and which companies will benefit first?
Japan really started reopening internally, domestically, from the second half of June or from end June last year. And also it relaxed its international travel restrictions only in October of last year. So in terms of pent-up demand from the reopening, I think 2023 could still see continuous pent-up demand and resilient consumer going forward, because the reopening was lagging other developed markets, and we are still seeing a resilience in terms of the consumer, in terms of its excess savings, in terms of willingness to spend on retail, and in terms of and services. So we've seen, as a first instance, we've seen positive contributions to retail names like department stores, or more recently, also we are seeing positive contributions to sales in convenience stores and drugstores. Also, other sectors of the economy are being impacted positively, like lodging, hotels. So in terms of this dynamic, I think it still has legs to continue going into this year, into 2023.
So financial markets are discussing a recession in 2023. How likely is that? How will this affect the Japanese economy and especially Japanese companies?
Yes, if and when we get a recession this year, it would also depend on the level of recession. But as a setup, I'll just want to repeat some of the things we've been talking to until now. One of the things is China reopening is positive for in the midterm for Japanese corporates fundamentals through both Chinese domestic demand, but also through inbound tourism into Japan. The Japanese consumer seems reasonably resilient, still having excess savings. It's possible that this year it might see a growth in its real wages, depending on how wage negotiations go just in the spring of this year. So we have these supporting fundamentals around the economy and the Japanese corporates. On top of this, I think Japanese corporates are very resilient, both in terms of fundamentals and in terms of valuations of their shares. So in terms of fundamentals, we see very strong balance sheets in Japan, where more than half of the companies have net cash on their balance sheets. We also have seen companies which are really focused on margins and returns and not chasing volumes. And this was the right behavior and still the right behavior at this point, and we've observed it in the companies. As an example, I can give you, let's say, for the automobile OEMs, in terms of recession, usually people will think of it as big discretionary items where demand is going to be impacted. However, this market has been undersupplied for so long. Also, the inventory levels are still very low. The companies have worked on reducing their break-even points and improving their fundamentals and are very resilient. So it's possible that in a case of a recession, they might be much more resilient than in past cases. Also, at the same time, based on sustainable earnings, through cycle earnings, the way we look at these companies, they're still very, very trading at very, very compelling valuations. So I think Japan Inc. is resilient. Of course, we are not investors who bet on the short term, but just looking at sustainable valuations based on sustainable earnings, they're still very, very cheap. And these valuations, to a certain extent, reflect these fears around recession.
So we already touched the topic of China is both the most important trading partner for Asia, for Japan, but also a systemic competitor. So do the opportunities or risks outweigh for Japanese companies?
China market is a very large market and very profitable market for a number of Japanese companies. So, and many of these companies, whether they be in the automobile OEM supply chain, whether it's in machinery supply chain, electronics component supply chains, have relatively big exposures to China. China as an export partner of Japan is very material. It's the biggest export partner with, on average, through cycle, 20% exposure of Japanese imports go to China, but also with many of Japanese companies have big presence on the, within China, and it's a very profitable market for them. So the opening of China, I think, is going to be, after COVID, is going to be very positive for Japan. And it would remain to be an important market for the Japanese companies. Of course, we've seen some changes in the competitive environment. We have been seeing them for a while, where Chinese companies have crept up in terms of the quality range, or become much more competitive in terms of quality of their products. And we've seen this in many kind of industries, in consumer staples, in cosmetics, in automobiles, in construction equipment or machinery. So it's very important for the Japanese companies to keep on innovating. They still have the advantage of brand and quality image, but it's important for them to keep innovating. And also the other thing that's very important is to really protect their markets outside of China into Asia, where we should keep on monitoring spillover from Chinese competitors into these markets.
So finally, let's talk a little bit about investing. So how do you position your portfolio currently? Where do you find investment opportunities in Japan? What industries and company are your favorites currently in this market stage?
In terms of how we invest, as I mentioned before, we really focus on sustainable earnings through cycle for the company. So we are not trying to forecast next quarter or even next year. We are in terms of earnings performance of the companies, we are thinking whether these companies, they're improving their performance in a sustainable way and what the market pays for this sustainable earnings. So we are focused on companies where there is big disconnect between valuations and the current market price. We're really focused on outliers in terms of valuations. These are the things that this process is very durable because it really exploits biases in the market. And biases is something which doesn't change in the market. I mean, different teams come and go, but biases are consistently present in the market. What's helped in terms of performance over the last year, we've seen a lot of good performance from, I mentioned the financials, where the market was really focused and extrapolating low interest rate environment in perpetuity and was disregarding the fundamental improvement in these companies. These stocks have performed for us, and even after recent performance, they're still reasonably cheap and on the right side of valuation. Other things that perform for us are things in the, as I mentioned, some things in the companies in the industrial or heavy industrial complex. This is where narratives of the market really changed from as energy security became a big focus of the market last year, and also these companies were help initiatives in terms of managing their portfolios and cost base. So these are areas of big performance for us. And as valuation upsides are becoming smaller, we are, of course, relocating some of this capital in other areas. Some of these areas where we relocated capital during the course of last year was some of these domestic retail companies or some of other retail companies with exposure to China as well, which the performance of which was really impacted by the COVID situation in China, and also Japan really reopened in the second half of the year. But this is some of the companies where relocated capital, and we are seeing some of their fundamental improvement and expecting some of their fundamentals to improve going forward, as the market was really extrapolating short-term concerns there. But in terms of valuations, based on our sustainable earnings, these companies were very cheap. Other companies where we are relocating capital are some of the chemical companies, which are really technology-based specialty chemical companies, which were really impacted last year by surging material costs, and they really transferred their pricing. They transfer the cost in their pricing with a lag. Over there as well, the market is really focused on the short-term headwinds, and this is one area where we could basically exploit this short-term focus of the market and set up the fund for longer-term outperformance going forward.
So this was Ivailo Dikov from Eastspring Investments. Thank you very much, Ivailo, for being with us today and sharing your insights into the Japanese equity market.
Thank you, Thomas. It was a pleasure to be with you. Thank you very much.